love them. So this is kind of like viewer mail, or what I love is I think I always put this offer out to my subscribers about, oh, like I'll help you go through and do a problem. So let's go through and figure this out. So this is involving depreciation questions. So let's take a look at this one. So you've got Smith's company purchased a mini computer on January 1st, 2022 at a cost of $52,000. The computer was depreciating using the straight line method over an estimated 5-year life with an estimated residual value of $7,000. On January 1st, 2024, the estimated useful life was changed to a total of 10 years, and then the estimated residual value was changed to $1,600. Prepare the year-end journal entry for depreciation on December 31st, 2024. Assume that the company uses the double declining balance method instead of the straight line method. Okay, so when we go through and deal with depreciation, the thing to remember is when we have over here, we have our acquisition cost minus salvage value divided by the estimated useful life. The thing to remember is when it comes to depreciation is that both the salvage value and the estimated useful life are both estimates, right? These are estimates, so they can change from time to time. The important thing is we're not going to get into a hot tub time machine, a DeLorean that can hit 88 miles per hour, go back in time, and then basically redo stuff. Rather, what we're going to do is we're going to handle any kind of depreciation changes prospectively. So let's go ahead and take a look at this particular question. So for this first part over here, on 1/1/22, I purchased a mini computer at a cost of $52,000. So the way that I would kind of go through and handle this part right over here is I would have equipment or mini computer, and this would be valued over here at 52,000. For every debit, I need a credit. I would basically go over here and I would credit cash over here at 52,000. Now, what happens is, and then this occurred on 1/1/22, and this is also on 1/1/22. So when I do the initial depreciation, the way this is going to work, so I'm going to record the use of the equipment. When I'm recording the use of the equipment, basically the journal entry is always going to be the same. I'm going to debit depreciation expense, and I'm going to credit accumulated depreciation on the equipment. Okay, so for this first year, right, my acquisition cost was 52,000, and I'm doing this straight line. So this is the formula here for straight line. We're doing the same amount of depreciation each year. So this is going to be 52,000 minus 7,000, which is my salvage value, right? The computer was depreciated using the straight line over an estimated 5-year life. So this is going to be the same as 52 minus 7, or 45,000, divided by 5, or I'm going to have $9,000 per year of annual depreciation expense straight line. Now, this question is really nice. Why is it so nice? Because I would do something a little bit more fun. I would say, well, we didn't buy it on January 1st. We bought it on, March 1st, right? So that's what my students would expect from me, but your instructor was much nicer in giving you this question. To record the use of the equipment, I'm going to debit depreciation expense, and I'm going to credit accumulated depreciation on the equipment. So this is both going to be here on 12/31/22. Now, what happens is at the end of the year, our temporary accounts are going to go through and get closed out. The depreciation expense is going to be closed out to retained earnings. However, this accumulated depreciation on equipment is now going to have an ending balance of 9,000. Remember, accumulated depreciation, because this has physical substance, we're not going to go through and credit the equipment. We're going to use what we call a contract asset account to accumulate that depreciation. So let's go over here. and I come over here to accumulated depreciation on equipment. So my balance as of 1/1/23 is the ending balance from the prior period. The depreciation expense gets zeroed out to retained earnings. Remember, expenses, revenues, dividends. These tell us what our revenues, expenses, or dividends were for a period of time. This is where we are accumulating the depreciation on that equipment. So over here, so in 2022 and then 2023, because it's straight line, we're going to be doing the same exact thing. We're going to be coming over here, basically debiting depreciation expense, and then we're going to be crediting accumulated depreciation on equipment. Okay, so now my balance in the accumulated depreciation on equipment as of 12/31/23 is going to be 18,000, or that balance before, basically plus the current year depreciation expense. So now we get over here to January 1st, 2024, and let's just kind of take a look at what's on our books, right? So basically this equipment is really never going to go away. And in terms of my accumulated depreciation on that equipment, right, my balance basically for this is going to be 18,000, right? And this is my balance on 1/1/24, right? So basically I'm just carrying down these values over here. So my balance on the equipment and then on the accumulated depreciation over here is now 18,000. Now, when it comes to this, on January 1st, 2024, the estimate of the useful life was changed to a total of 10 years, which, by the way, for a mini computer, that's probably never going to happen, but it was changed to a total of 10 years. And the estimate of the residual value was changed to 1,600. So prepare the year-end journal entry for depreciation on December 31st. Assume that the company uses straight line, basically uses double declining balance instead of the straight line method. Now, I have to assume that we made a change in depreciation methodology, which is okay, you can do, but it does require a lot of additional disclosures. So when we're going over here, I'm assuming that we're adopting a new methodology, right? So over here, we're now using double declining balance instead of straight line, effective January 1st, 2024. So when we do double declining balance, this is basically going to be my cost less the accumulated depreciation, basically divided by the estimated useful life. I'm going to multiply this by 2, and this is going to give me my annual depreciation under double declining balance, right? So this over here, right, this is basically my formula for double declining balance. So now when I go through and look at this, I'm going to basically say, okay, I've got 52,000 minus 18,000 divided by 10 years, which is the new useful life. Now, here's what's also kind of perplexing, right? The estimated useful life was a change to a total of 10 years. When I write these questions, is this 10 years from January 1st, or is this 10 years from the original 5? Now, if it was, in fact, and this is the way this is worded, is very vague. So you could basically, I would kind of go up and say, well, is it changed from 10 years as of January 1st? Or is it going back and retroactively saying, well, as of January 1st, it was now 10 years? The answer is, I don't know. And I'm going to assume it's 10 years going from January 1st. So coming over here, right? So you're going to get 52,000 minus 18,000, or 34,000 divided by 10. and we're going to multiply that value by 2. And this is going to be 34,000 divided by 10 multiplied by 2, or 6,800 is my annual depreciation under double declining balance for 2024. Now, one of the things we also have to be very, very aware of is when we are using double declining balance, notice there is no salvage value included in here. It's just accumulated depreciation. So what we need to do is we need to say, well, the cost of the equipment over here was at 52,000. My depreciation expense, and this is for 2024, was basically 6,800. Now, what does this mean? Well, my total amount of my accumulated depreciation, since I had already taken 18,000 previously, right? My accumulated depreciation balance is going to be 24,800. So my net book value over here is now going to be 27,200. When I go over here and I look at this net book value, I'm going to compare this to the salvage value. Now it tells me my new salvage value over here was 1,600. So I come over here and I basically say, okay, salvage value is 1,600. Now I can continue to depreciate the asset provided the net book value is greater than the salvage value. So when I go ahead and look at these different questions, well, my net book value is greater than my salvage value, so I can keep depreciating. So then over here, look at this again, my depreciation expense would be 6,800. So let's what this asks. So January 1st, prepare the year-end journal entry for depreciation on December 31st, 2024. So what I would do is I would say 12/31/24. I would debit depreciation expense. I would credit accumulated depreciation on equipment. And this would basically be over here for 6,800 and 6,800. Record equipment, record depreciation expense. Now, when I look at this question again, there's a lot of different things that could basically say, well, what's another way this thing could go? Well, if you had 34,000 divided by 8 multiplied by 2, again, I don't know if that, again, like that 10 years, and this is the lawyer in me, and I probably look into these things too much. But again, if it was 10 years, right, is this 10 years from January 1st? You could also give an answer that if we said, well, this assumes that 10 years from 12/1/1/24, or if you said it was 10 years from 1/1/22, then what you would be doing is you would take, well, it's 52,000 minus 18,000 divided by 8, which is really the asset's remaining useful life, or 34,000 divided by 8. And then we would multiply this result times 2. So then this would over here be 34,000 divided by 8 times 2. And I would get 8,500. So instead of 6,800, the answer would be 8,500. But even if I used 8,500, I'm going to be okay because my net book value is still greater than my salvage value. Because even if this was 8,500, you're looking at another, what is it? This was 8,500. 8,500 plus 18,000. And then your net book value is still 25,500, which is greater than the salvage value. So again, the way this is worded, very vague. I would want additional information basically going through and dealing with this. So again, it could be interpreted two different ways, right? But given the information that I was provided basically from my viewer, by the way, thanks for submitting this question. This is how I would answer this question. So I want to thank you for joining me here today on this really brief video from a YouTuber question, a subscriber to the Accounting Professor. By the way, everything in here is mine. These are my opinions. The question was provided to me from a subscriber. Have a great day, and I look forward to seeing you on future videos. Have a great one.